Hello everyone and welcome to the 2017 Halftime Update. My name is Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. I hope you're all having a wonderful summer thus far, enjoying the weather, some time with your family and friends. As you watch this video, please feel free to pause and rewind if need be, and always know that you're welcome to reach out to me personally if you have any questions about anything you learned today. I have a tendency to move pretty quickly, so again, the pause and rewind feature is valuable, so let's just go ahead and get started here with one little piece of housekeeping. In order to optimize your screen so it makes seeing everything a lot easier, what you're going to want to do is click on the gear button in the bottom right hand side of your screen, and then there's going to be a drop down next to quality, and you're going to want to make that whatever the highest quality that you can get. So whether that's 720p or 1080p, sometimes automatic will work but not always. But once you've selected that, the last thing is you'll want to select the little picture frame looking thing in the bottom right corner, and that'll make your screen full screen, which again will make it a little bit easier to see everything I'm going to show you here. So without further ado, let's go ahead and move forward with the material. We're going to talk about a few things today. First, I'm going to go into talking about domestic stocks, so here the stock market here in the US. Then we're going to talk about international stocks. From there, I'm going to move forward to talking about bonds and interest rates. Then just a little bit about commodities and currencies, and we'll finish up talking about a few things having to do with looking forward, say, at the rest of this year. All right, so let's talk about some domestic stocks. So the domestic stock market here in the U.S., when we look back, call it 33 months, you can see here there was a 2-year period over which the market really kind of went nowhere. In fact, over the course of about 19 months or so, we actually saw the market move in a sideways fashion with a downward bias. And you can see the 2 years that took place prior to Election Day, which is right here on the, call it, right third of your screen. And then obviously how the market's done since the election, which has been, whether you were surprised by that or not, it doesn't really matter to me one way or the other, but the market has definitely done well since the election for whatever reason. Moving forward here, the post-election day, so here's election day again, we're zooming in, and we can see that ever since election day, we've pretty much seen all the trends turn northwards. So this gray line right here with the dots is a 1-year trend. The blue line is a 3-month trend, and the red line is a 1-month trend. And what you want to see is the 1 month above the 3-month, and you want to see the 3-month above the 1 year. We could throw one more in here if we wanted to, but I wanted to keep this a little bit cleaner if possible. So bottom line, the market does look really, really good right now. Since election day looks fine, so there's really no need to be hugely concerned just yet, although there are a couple chinks in the armor, which I'll go over a little bit later in a couple slides here. So actually, one of those chinks in the armor we'll talk about is something called negative divergence. So down here in the bottom is something called RSI 14. This is a momentum indicator, and typically what we see is the market typically follows momentum. So here you can see up top the S&P 500, so the U.S. stock market. We've got a high here in, call it March 1st actually, and then you can see it pull back a little bit, but generally speaking, over the course of the last few months, the last quarter, we've seen the market go up and create a new high. Down here, however, you can see that momentum created a high right there at the beginning of March, and then declined until June, where we saw a lower high and continue to see declining numbers. So that could potentially pose a problem going forward, and it's just something that I think we need to watch. Again, trends are still positive, short term, intermediate term, long trend. Everything looks pretty good right now, but again, stuff like this just kind of raises your eyebrows and makes you want to pay a little bit closer attention for a number of reasons. Again, I'll get into a couple other chinks in the armor a little bit later here in a second, but let's talk now about international stocks. So looking at the international stock market outside the U.S. here, it looks a little different if you go back to election day. So if you remember, I'll go back real quick here. This is the election day chart for the U.S. stock market, and how pretty much after election day, the market just pretty much soared from there. Whereas if you look at the international market, here's election day, where afterwards the market pulled back quite a bit. Now, some of that was due to Mexico. Obviously, if you remember going back to the election, there was a lot of hoopla going on about what was going to happen between the U.S. and Mexico, the wall and all that fun stuff. So you can see a pullback here, but then since then we can pretty much see that November was the low toward mid to end of November, and then you've seen the international markets doing relatively well as well going forward. So what I also wanted to show you is similar to the U.S. stock market. Again, you can see some short-term higher highs, but some short-term negative momentum divergence here as well. So again, not hugely important, nothing to go running into your portfolio and selling everything that you own, but it's definitely something I think that we need to pay attention to. Moving on to bonds and interest rates, the last time we did this video, so if you go to our website at www.libertaswealth.com and you go to our media page and videos, you'll see back in January when I did the U.S. Stock market outlook for this year that we talked a little bit about bonds and interest rates. And this was a similar chart that I showed before. So what we're looking at here are long-term, so 30-year interest rates. Now going all the way back to 1980, 81, you can see there's pretty much been a downtrend in interest rates, and I don't think that's any surprise to anyone. If any of you have been around long enough to know what you were paying on your mortgage back in the 80s, if you knew what you were getting on interest rates at the bank, whether it be in your savings account or CDs, obviously rates were a whole lot higher back then than they are now. When you look at your rates at the bank now, I mean, what are you getting on your CDs today? What are you getting on your savings accounts today? Furthermore, what are you paying on your mortgage today? Most people are paying anywhere between, call it 3.5% and I'd say 4.5% on average, and that's comparable to back in the 80s. We were looking at interest rates in the 15s, which was pretty crazy. But anyway, we've seen over the course since 1981 or so, we've seen this really long downtrend, which at some point has to turn around. Now, right now, in the short term, interest rates kind of bottomed here in the beginning of the year and then spiked. And then we've seen interest rates kind of pull back right into the middle. If we were to draw an imaginary line in the middle of these two parallel lines, it's pretty much sitting right in the middle, call it a mean reversion, so to speak, since this peak, which occurred a little bit just a few months ago, actually. So from here, we don't really know where interest rates are going to go, but we can look at bonds and we can say the same thing on the bond side. So when I say bonds, what I mean by that is bond prices. So when interest rates go down, bond values go up. When interest rates go up, bond values go down. So again, we go back to this chart here. See, interest rates have gone down recently, which means bond prices have gone up. So when we look at this long, huge trend line going down from 1980s of lower and lower rates, and then we look here and we can see higher prices in bonds, what we know is that when, not if, interest rates start to go up at some point, and again, I don't see that the long-term rates spiking up to 4, 5, and 6% anytime this year, but at some point here, we're going to start to see rates going up, at which point we're going to see bonds come down in value, breaking this lower trend line, and I think at that point, it's going to be really important to be careful with your bond positions. In other words, just because bonds are safe, or just because people tell you bonds are safe, doesn't mean they're necessarily safe. I mean, you can go all the way back here and see bonds and what they did back in the late 70s, early 80s, going down quite a bit, and that was because rates went up quite a bit. Here's the rates going up right here, and if I go to the next slide again, here are the bond prices going down, so bonds falling in value. So I hope that makes sense. If you have any questions, again, email me, call me, and let me know. Let's move forward and talk about commodities. This is kind of interesting. The commodity index has pretty much taken a beating, largely due to oil and energy stocks, energy positions, we'll call it gasoline, oil, Brent crude, sweet crude oil. And you can see that since last year, we had this big bounce in oil where it went up about, call it 23, 24%. And this is supposed to be bounce, by the way, not bound, so I apologize for that. But since then, it's pretty much gone sideways with a downward bias. So since the peak, which occurred just earlier this year, the commodities market's down about 9.1%. Now, we just had an article published with a chart in MarketWatch, so Wall Street Journal's MarketWatch.com. And if you go to MarketWatch.com and you just click on the search button, which is a little magnifying glass in the upper right-hand corner, you'll see that you can type in my name or our company, Libertas Wealth Management, and you'll get this chart. So if we drill down further, what you'll see is from best to worst, commodities like palladium and rice and lean hogs, which is always something to joke about in the commodities world, being the better performers, aluminum here, all the way down to the horrible performers like sugar and orange juice, iron ore, and natural gas. But you can see the energy positions here really holding down the commodity index. So Brent crude, heating oil, and oil and coal, natural gas, again, I mentioned that a second ago. So these energy positions have really been pulling down the index quite a bit. But if we look at palladium, for instance, you can see how well it's done. This black dotted line is actually the first of the year. So 23% roughly year-to-date palladium has gone up. On the other hand, however, we can look at sugar and see how sugar is done, which has been down quite a bit since its most recent peak, down about 44% since it peaked a while back here. So moving on, just a really brief discussion on currencies. I just want to bring up the US dollar. So here you can see the US dollar. Again, the black dotted line is the first of the year. And what we've generally seen since the first of the year is a decline in the value of the US dollar, which was pushed up the value of foreign currencies. As the dollar falls, we can also typically see an upswing in gold, because the dollar and gold do typically tend to be inversely related, although you can still buy gold in other currencies, so you have to keep that in mind as well. So moving forward, what now? So what do we have to look at for the rest of this year? I think the first thing that we need to consider is market seasonality. So Dorsey, Wright and Associates does this study pretty much every year just after May 1st, where they go back and they say, okay, if I invested $10,000 in the Dow Jones Industrial Average, so $10,000 in the Dow, and we invested that on April 30th of 1950, and we sold everything we owned in the Dow on October 31st, so call it Halloween of 1950, and went to cash. So in other words, we took our money out of the Dow and we went to cash and stuck it under the mattress for the entire winter, and then went back in 1951 on April 30th, invested the proceeds, sold it again on Halloween, went to cash for the winter, and so on and so forth, all the way until 2016. You can see here, over that huge long time period, we would have lost about $123, which is pretty wild. What's even more amazing is that if you invested that same $10,000 instead on Halloween in 1950, and you sold the proceeds on April 30th and went to cash for the summertime, so basically went on vacation with your investments, so to speak, for the summer, and you did that every single year in being invested only between October 30th and April 30th, 1950, 51, going to cash for the summer, that same $10,000 grew to the tune of $975,000, which is, again, pretty amazing. So the point here isn't to say we should only have our money invested in the wintertime and never have our money invested in the summer. I think what it tells us is that we need to pay attention to how the markets react in the summer to give us a better idea for how things are going to be maybe in the wintertime. Now, it's going to be really important here in July and August to see what happens and whether or not the market gives us some good performance. But that's where, again, it's crucial to have exit strategies, to have a way to hit the sell button and walk away and put your money on the sidelines, as opposed to just staying invested all the time. Moving on here, this is a really messy chart, and I apologize for that. But first thing I want to show you, this black arrow. This represents the longest bull market in history. So the longest up market in history, which took place right before Black Monday, which is this big, huge drop right here you see on the far left-hand side of the screen. And the other black line that we're looking at is what we're living in right now, which is the second longest bull market in history. Now, I have some really great friends in this industry, some who may disagree with me on whether or not this is still the longest or second longest bull market in history. We like to define a bear market as a drop of 20% or more in the S&P 500. So, but there definitely have been some huge declines around the world, and I want to make sure I do make that point. But bottom line, we still have seen a pretty long uptrend here for a really long time. And when you look back, you can see, again, going back to that negative divergence we talked about earlier. So this is longer term. This is a weekly chart. So you can see the market went up here in the late 90s and how we saw higher highs and higher lows. So in other words, an uptrend. If you look down here at momentum below, we saw lower highs and lower lows. So you see less and less participation, or in other words, less and less momentum, which again is what typically precedes price. So price follows momentum in most cases. Doesn't happen every time, but it happens, I think, a lot of the time. And you can see this blue line is just a trend line that got broken here. Here's the market top This is the 2000, 2001, 2002 dot-com bubble, and then the decline that took place after that. Then we see the huge move up from March of 2003 to the peak in fall of 2007. And again, we see this upswing of higher highs and higher lows. And if you look down, you see this lower high here. So here's a high, and then here's another lower high in momentum below, which preceded a drop. Here's the top of the market mortgage crisis, 2007, 8, and 9, and then the market drops from there. Now, since then, we've seen pretty much a big-time bull market, at least when we scan out to the 30,000-foot view here, a weekly chart looking back years and years and years. And what you can notice here is this, again, decline that we saw in 2014 and 15 that was, again, possibly preceding a drop in price, not unlike the ones we saw in 2007, 8, and 9, or the ones we saw in 2000, 2001, 2002, except what happened? Well, here we have rising highs, rising lows. Here we have declining momentum within the second longest bull market in history, and it doesn't top. The market pulls back, creates a lower high, pulls back again, lower low, lower high again, but then all of a sudden, just before the election and after, we see this surge to the upside, which is what we're living in right now. So the average market crashes about every 7 years, and right now we're living in year 9. And in order to beat the record, again going back here on the left to the 80s and 90s, we have to go beyond 14 years, which I guess is entirely possible. Nobody knows for sure, but it's possible. Let's talk a little bit about the post-election year that we're living in. So in the 4-year election cycle, obviously, we are living in the post-election year. This chart is provided by Stock Traders Almanac, which is a wonderful place to get good seasonal and historical statistics on the markets. But what I want to really point your eyes to here is this right here. So it's a little old, going back to early June. You can see this is the year we're in right now, so 2017. You can see whenever a Republican gets elected in their first term, the total performance of the market's down about 2.5% or so, typically. And then you can see in the 7th year of a decade, so here we are in 2017, so the 7th year of this decade, we typically see the market peak right around July and August, and then a drop through the end of the year, call it a plateau through November, December. Now, a lot of that is skewed by Black Monday here in October, so that is, I just want to point that out. But as we see this rise, again, I think it's going to be really important to see what happens here this next couple months through the summer to determine whether or not we're going to track the rest of this year through what would be a typical trend on the top side here. So a typical election year, which is up around, call it 7% or so, 7.5%, or if we're going to see maybe a worst case scenario down here when we see a new Republican elected. Same story here. I won't go into the details of what this means, but there are three metrics that we can follow at Stock Traders Almanac again. The beginning of the year, there's the Santa Claus rally. That's one piece of the trifecta. That's the end of the trading year and the first few days of the new year. There is the first week of the year, so the first 5 days. That's the second part of the trifecta. And then there's the month of January, which is the January barometer. And all three of those were positive this year. So if you look here, typically the black line is when we have all three of those things being positive. We're looking at a return somewhere in about the 17.5% range. When all three are positive in a post-election year, the numbers get even better. So that fares really, really well for us, statistically speaking and historically speaking. Now, history doesn't tell us what's going to happen tomorrow. It just gives us a good idea of what's happened in the past. You can see where we are right now through about 2/3 of June. The question we're going to have now is, are we going to continue higher, tracking either A, a post-election year where the trifecta is positive, or B, just a normal year where the trifecta is positive? So we don't know, but here is a typical post-election year, which pretty much peaks in July and flattens out for the rest of the year. So again, I know I've said it a few times, but it's going to be really important to see what happens the rest of this summer. So in closing, just want to share a couple things with you here. First, one of my favorite quotes of all time, and if you've been reading our commentary, watching videos, screencasts like these, listening to our podcasts over the past few years, then you've probably seen it before. But this guy here, Warren Buffett, He said, and it takes a while to look this up online, the disservice done gullible students and investment professionals who have swallowed modern portfolio theory, or in other words, buy and hold, has been an extraordinary service to us in any sort of contest, whether it's financial, mental, or physical. It's an enormous advantage to have opponents who have been taught that it's useless to even try. So he's talking about the fast money here and how it sure is a convenience to have the market and the Wall Street brokerage firms who have taught investment professionals and investors like yourselves that it's better just to invest your money and leave it there and not touch it. He's saying that's an enormous advantage to the fast money, the smart money, people who are paying attention. So in closing, again, I want to make sure we point this out. We are not ever going to attempt, I should say. I mean, we want to try, but I mean, the likelihood of missing every 8% drop or every 15% drop in the market is very unlikely. But if we miss 8%, so if we participate in an 8% drop in the market, it only takes 8.7% to get back to even. Even if we participate in a 15% drop in any given year, it only takes us 18% to get back to even. But if we lose 20%, 30%, it takes mathematically 25% to get back to where we started. If we lose 30%, it takes 43%. Back in 2008, the market was down 37%, so if we lose, say, 40%, it takes a 67% gain to get back to where we started. And last, of course, you've probably seen this statistic here. If you lose half your money, it takes a growth rate of 100% to get back to where you started. Now, if that math doesn't make sense, let's just say you've got $1 million, you lose 50%. That means you've got $500,000. If you grow your account 50%, you only have $750,000. So heaven forbid you're taking money out of your portfolio. If you lose 40% and you're taking 5% out per year and the market crash takes 2 years, now you have 50%, so $500,000, and now you need to make 100% of your money back, all while taking 10% withdrawals. Pretty crazy. So I'll leave you with that, and I tried to make this one a little shorter, and I pretty much failed, but even though I talked too fast here, but I just want to, again, remind you, if you have any questions at all, if you'd like to receive an intro kit sent your way, if you'd like to be signed up for our market commentary and things like this, go to our website and sign up, or email us and ask to be signed up. We'll make sure you get our commentary videos, podcasts, screencasts, and so on. If you'd like to set up a time to talk about your retirement plan with myself or one of our financial advisors, please, without a doubt, please reach out to us. And remember, you do not have to be a client to ask a question. So we got rid of our interrogation room a long time ago. Used to have the metal desk and the swinging single light bulb, but it's gone now, I promise you. So again, thank you so much for watching. Thank you to our veterans and active military personnel. May we never forget what holidays like this one upcoming is really all about. And with all that said, I hope that you all have a wonderful Independence Day with your families and an even better summer, and we hope to talk to you soon.